Welcome to Season 3 of the Knack for Business podcast. Over 200 episodes strong, we're here to ignite your entrepreneurial spirit with fresh insights, networking gems, and creative strategies that elevate your game. Are you ready to discover what your Knack for Business truly is?
Today's topic is Fund Your Business, Fuel Your Dream. Your hosts are Brittany Franspet from Creative Insight and Wayne Pratt from Motivate You Inc. So what can you expect from the Knack for Business podcast? Well, it aims to help you find your feet in the business world. You're just starting out or you've been at it for a while. We have something for everyone. Each episode, they dive deep into a particular area of business and explore the ins and outs of that subject. The interview guests that are experts in their field who share their success stories and their experiences. They offer practical tips and advice. Our guest today is Leo Kanell from Seven Figures. Leo is the founder and CEO of Seven Figures Funding, host of the Seven Figures Club podcast, and co-creator of MyFigures FinTech app. He also hosts the Go Figure Show on YouTube. As the author of the Amazon bestseller, The Business Funding Formula, Leo has helped secure over $500 million in funding for thousands of clients. His passion is supporting startups and small business owners with aggressive funding solutions and powerful educational resources. Leo has pioneered a funding partner portal used by over 9,000 professionals nationwide that helps loan brokers, consultants, and coaches secure 0% interest funding for up to 20 months. A dedicated husband and father of five, speaker, fitness enthusiast, Leo resides in Lehi, Utah, where he enjoys wakeboarding in the summer and snowboarding in the winter with his family. Leo, welcome, and do you have a favorite quote or saying?
One of my favorites is do what you say you're going to do. I remember starting a company years ago that grew really fast, but it didn't have a foundation or values and principles. When I started my company in 2018, we said, okay, we're going to have these values and principles written out. The first one I'm looking at is on our wall there, says we do what we say we're going to do.
That is perfect. $500 million worth of funding for businesses. This, it's a large number for mere mortals, unless you're a government agency or a large corporation.
Right?
What were you like? The problems you're solving must be fantastic. Like, how many people is that you've helped out?
I mean, it's probably somewhere around 15,000 small business owners. You can go out and get big financing loans and commercial real estate loans. And I've done that, and those can be millions of dollars, but they take a long time. They're high stress. They're up and down. But I found that niche of small business owners, of which there's many who are ignored by banks and lenders, was very satisfying. There were more of them to help. And just getting somebody anywhere from $25,000 to $150,000 for their businesses has allowed us to make a bigger impact at the end of the day. And it's cool when you bump into those people years later and they have employees and they're buying their own building, and you played a small part in helping that to become.
You find most of it's in the real estate sector, or is it a mixed bag between retail and real estate?
It's very much a mixed bag. We've seen a lot of e-commerce, certainly some real estate businesses, a lot of online businesses, but a lot of blue collar businesses, a lot of plumbers and electricians and HVAC operating businesses that need financing options that are often not given the attention they deserve.
My father was an entrepreneur. He lost a business waiting for financing. So I know of what you speak. What are the mistakes happening and how can you avoid the big ones?
You just mentioned one of the big ones there, Wayne, and that's don't wait to get financing. You want to get access to lines of credit, business credit cards, revolving accounts that you're not paying on unless you use them. But if an emergency happens or an opportunity, you want to be able to have access to tap that funding. Because if you don't, you may go out of business or you may miss out on those big opportunities. So one of the big keys is get it well before you need it, because you never know if you're going to need it.
Percent interest funding. Is that still available? Is that still a thing that's every time? Yeah, up here in Canada, our interest rates are dropping down, but you don't hear a lot about 0%. I've just seen some car loans coming up from the manufacturer. They're starting to get back in the game of 0% because everything's stabilized in that market. Is that holding true throughout the US right now?
Yeah, it's held true over the last decade that I've been working in the business finance sector. Business owners, new and established, are still able to tap some of these 0% interest accounts. They're usually 0% interest for 12 months to 18 months. They have a chance to start or grow a business or do a project and pay 0% interest. We advise them to try and generate that return pay that money back at 0% interest. It is an amazing opportunity to do that.
How do you keep people from chasing the wrong money? How do you keep them with blinders on?
Number one, you want to have a complete business finance marketplace. If you go to your local bank, especially in the US, and I would imagine in Canada as well, you're going to look at government backed SBA type loans as one of your only options. A lot of businesses don't qualify for that. And so then they get turned down and they think they're stuck, or they come in with the wrong mindset thinking that they're going to see a consumer financing loan that they can use to start a business. If you're looking to start a business is inherently a higher risk proposition than giving a consumer money to go out and buy a car that they're going to drive around in. And so the default rates are going to be higher with business, which means the rates are inevitably going to be higher. And the good news is, as a business owner, you generally should be making 150 to 200% or more on that money, what we call ROL, return on loan, return on line of credit. I dedicate a chapter to it in my book, The Business Funding Formula. Even if the money was expensive and cost me 25%, but I didn't have to put up any collateral and I was able to make 200% on that money in a 12-month period. 200 minus 25 tells me I'm making a pretty good return of 175% there, and return I would not have generated without taking out that funding. And so just that mindset of understanding the difference. And then if you can work with someone who does have every option, that helps because one of the other challenges we see in this space is there's a type of loan called a merchant cash advance. These are definitely available in the US, Canada, and other markets. These are based off of your business bank statements, and sometimes it's the only product you might qualify for, but they're awfully expensive. They might be a 6 to 9 month term, so you're paying it back fast. And the interest might be anywhere from 30 to 50%, although they don't call it interest, they call it a payment factor rate. And so understanding that might not be the best loan offer for you. And that's why it's important to work with someone who has every option. Certainly helps if they have a decade of experience as well.
There was a time and place where some lenders on some deals actually either had the right to equity or actually got equity in the deal and they could take it or leave it. Are those equity deals gone away?
Yeah, those equity deals would be with private investors that, or even maybe a private equity group where they have a conversion note or a venture capital firm and they have the type of conversion note where it could be a loan, but then it could also turn into an equity play. Those are not in the regulated sector of banks, credit unions, and lenders traditionally working with businesses based on credit and income. But if you're in the venture capital space, you might be taking out funding meant to be equity, but convertible, depending on what both parties agree to. But it's never something that would be a surprise. In today's lending and funding environment, things are more transparent than they've ever been.
How does somebody make money on that deal?
Yeah, great question. So when they're getting those 0% interest financing offers of 25 to $150,000, then we're having a one-time success fee that's coming out of the funding, just like closing costs in a mortgage. So maybe it's a 5% success fee with a cap on it. Somebody gets $100,000 and they pay a 5% success fee or $5,000, but it's only after they've gotten the money approved.
For a business then to say, hey, Leo, I need some cash. This is where I'm pinned down. What should they have in place? What are the qualities they should have in place for them to come knocking on your door? And if they don't have those qualities, what should they do?
There's three key factors that can help somebody be fundable to get financing for their business. The first one comes back to personal credit. And there's a lot of misinformation out there where they say, hey, you don't need to worry about personal credit. You can just have good business credit. But the reality is, until you have a business doing $50 million a year with really good established business credit and payment history, your personal credit as a business owner and entrepreneur is going to be the backing for much of the financing decisions you get as a business owner. And so the first thing you want to do is make sure you understand credit and that you have a high personal credit score. In the US, that's going to be a FICO score of at least 700 or 720 or higher. In Canada, it's going to be Equifax, same scoring model, same system. You're going to want to have a good credit score. One of the key factors is having your credit cards that you have personally on your credit report paid down below 30 to 50% of the limit. So if you have a $10,000 credit card, you'd want that balance to be below 5,000. If you had it below 3,000, even better. That's going to put you in a great position credit wise because there's funding options you can qualify for just based off of good personal credit. Second thing they'll look at is how do you take good care of your business bank accounts? If you're a business owner who is constantly putting your bank account in the negative, you'd be surprised how many business owners do that. They'll have a check that bounces, or the bank will cover it for massive overdraft fees. I saw a business owner with a negative $70,000 balance in his bank account. It was $70,000 below zero. The bank didn't feel bad or was okay with that risk. A lot of risk on the banks. What if that business goes out of business and they're left holding the bag for 70 grand? A long time. And they did this all the time. This bank was literally just making thousands and thousands of dollars because they kept putting the bank account in the negatives. That's the number two factor. How do you take care of your business bank account? The third factor is, what do your business tax returns look like? Those are official documents where you show income. Maybe you're good at writing a lot of things off. You can add some things back in. If you pay yourself a W-2 salary as a business owner, you can add in any depreciation, which isn't really a cash expense. It's just saying equipment and assets you own are worth less today than they were a year ago. If your business tax returns are at least break even, by the time you add some things back in, there's some cash flow, there's some net income there. It's tough for the bank to extend you a business loan. If your business taxes show massive losses, it's very unlikely they're going to give you a loan.
One of the things about a podcast is you get to educate the client before he becomes a client. What do you want or hope for about educating the client before he does business with you?
Yeah, great question. Those three key factors of how they take care of their business bank account and their personal credit, those are two factors that will help. But also, one of the big things that really makes a difference, and if you ever watch the show Shark Tank, one of the expert entrepreneurs on there is Damon John. He talks about proof of concept. If you're a business owner, every lender wants you to pay that loan back. And one of the key ways that you'll know you'll be able to do that is if you have proof of concept in your business. If you're taking out a $100,000 loan for a piece of equipment that you know is going to generate more revenue and sales and do it profitably with positive cash flow because 25% of your customers already told you they would buy that service if you had that piece of equipment, that's a smart proof of concept. You can take that lending and money out and know that your odds of success, of paying it back and success are very high versus, oh, I just spoke to this guy. I'm going to put $100,000 into a brand new marketing campaign that I've never done before, that I have no idea if it's going to work. I'm just hoping and praying it does. I'm going to take this money and just put it into that new marketing campaign. That's probably not something you would want to do. You would probably want to start out small, get that proof of concept that a $5,000 investment into the marketing campaign works versus dumping massive high risk amount. One of the misnomers about entrepreneurship is entrepreneurs are big risk takers. Sure, they are, but they're calculated risk takers. And the ones that do well manage risk every single day. And that's what they think about. How can they reduce risk? So that proof of concept is something a business owner needs to be very familiar with. Nobody wants to see the business owner take out a massive loan, invest it into something that's unproven and untrackable, that they have no experience or proof of concept with, and see that work out badly for them.
You've written a book. It's even a best-selling book, which is more credible. What are the principles you lay out for the entrepreneurs in the book?
The first thing I like to share is case studies, right? Well, give me some examples of how positive this can work out. One of the case studies that I share in the book is the entrepreneur Phil Knight, who started Nike. When he started Nike, he had a little bit of money that his dad gave him and a little money that he had saved up, but that wasn't enough. And so he had to use what we call the business funding formula to grow his business. It took him 2 decades before the business was at a point that it could have an IPO, an initial public offering of stock. And once you have that initial stock offering, you get a bunch of cash in the coffers and financing. Your business is pretty easy. But before that, it's very difficult. And for him, the formula that you follow is you establish relationships, business bank accounts, put money in there, run your sales through that bank, and build a relationship with that bank where they can issue you a business credit card, a business line of credit. Step by step, you're building that relationship. And as you build it, they'll increase your credit line, your credit limit as your business grows. At some point, you may cap out or they may stop lending, and then you're looking to build another relationship. And so, this formula that we share is one that's been happening for decades. Of course, things are a little different now than they were back in the 60s when he started Nike, but the concepts are still the same. Go in and meet the business banker, set up the business bank account, build the relationship, build the history. And one of the key things that he did is he did what he said he was going to do. He would take out the loan, the line of credit, and he would pay it down to zero after a few months, and then he would use it up again to buy inventory, have some sales, pay it down to zero. When a lender can see you, and especially in today's world of automation, they see you use a revolving account and pay it down to zero and use it and pay it. Nothing is going to tell the algorithm more that you're a credible customer and business owner than doing that. For example, one account that I started out with had a $10,000 credit limit. I would use it, pay it down to zero. I never asked the lender to increase it. It was where I was banking. Over a 2-3 year period, now that same account has a $115,000 limit because I built that credibility. I built that relationship by the way I manage the account. If you can do that, those are formulas that are tried and true and give you access to capital so that if an emergency happens or a great opportunity, you have the ability to pull the trigger without draining all the cash in your bank account.
Entrepreneurs who live on the gross, they don't realize they have to pay taxes. They don't realize they have to pay stale inventory. They don't realize they have to pay XXY. They live very large for 2 years and then go bankrupt. How do you convince real business people the difference between revenue and profit?
Boy, it's one of our favorite issues that we have decided to personally attack and serve business owners with. And the statistics bear this out. There's a great entrepreneur by the name of Don Valentine. Don Valentine is the co-founder of Sequoia Capital. Sequoia Capital has invested in a few companies we've all heard of: Apple, PayPal, Google, NVIDIA. We've seen them in the news with a lot of the AI hardware that's being sold today. The two things he taught all of his entrepreneurs that he mentored and invested in are: listen, there's two financial metrics you must watch at all times. You need to have high gross margins and you need to have cash flow. Everything else doesn't matter. I just saved you $100,000 of an MBA. 82% of small business owners go out of business because of cash flow issues. They don't know how to create it. They don't know how to manage it, and they don't know how to forecast it. And that leads to bad decisions because, just like you said, Wayne, they look at the business bank account. Oh, there's $50,000 in there. And they think it's all available to do whatever they want with it. And it's not, because you've got payroll expenses, you've got rent expenses, you've got all these different projects that you might be working on. And so managing that cash flow is everything. That's why we built MyFigures, which is a cash flow platform where, as a small business owner, anywhere on the planet, by the way, you can create cash flow, track it, and forecast it. The ability to do all three of those things is what helps you differentiate between actual cash flow money that's coming in that you can use to pay your bills, to invest in future projects of the business, R&D, whatever the case may be. If you don't manage that cash flow, then you'll likely go out of business. The reason we built it is because nobody had done anything like that. Everything was managed manually by chief financial officers. And if you're a small business owner, you don't have 400 grand a year to invest in a chief financial officer.
I've heard of factoring as another means of handling cash flow. Like, you need cash flow, all of a sudden there's a surge, and you've sold a widget to pick your largest retail outlet that's in the US or Canada, perhaps you're in both places. And, the person buys the receipt. That way you have instant cash. Is that one of the other methods of garnering cash quick without going through a lender, or is there other methodologies to apply?
Yeah, great question, Bernie. It's definitely something that, for the right business, is a good vehicle. And what will happen, and for example, one of my friends is in that position. He owns a framing business, so he'll do construction jobs to build homes and commercial properties, and he might not get paid on the job for 60 to 90 days for work that he is doing. Because he has that 60 to 90-day delay in getting paid, that's where it makes sense for him to take out a factoring loan where he might have $100,000 in invoices that are due that are going to be paid out in 60 to 90 days, but he needs to make payroll and pay his team for the work they've done for supplies for those jobs and projects today. And so using a factor company, he might be able to get 90% or 95% of that money up front. And then the rest of it, when the payment comes in, will go back directly to that factoring company that advanced him the money so that he can make those projects work. And so that's absolutely something that happens. And it definitely makes sense. It's usually lower risk for the lender. Now, one of the qualifications for that isn't necessarily all on you as the business owner to have good credit, but it's actually going to be on your customers. These customers who are paying you generally need to be pretty decent sized corporations with good business credit themselves and or government agencies that have accounts receivables payable that they're paying to you on invoices for work done that might be paid out over 60 to 90 days. And yeah, it's definitely a tool that if you're a business owner that you've got invoices out and you know it's going to be 2 or 3 months later that you get paid for work already done today, then it's absolutely a necessity. Another example you gave is a great one, right? You're trying to get into Walmart and Walmart orders a bunch of your product. They might not pay you up front. They might only pay you after sales happen. And yet you've got to get that inventory purchased and sent to those big retail stores across the country. You might even need 6 to 9 months to make that happen. These are the things you want to think about beforehand, not afterwards when you're in a bind.
Are there any other types of financing models that work like factoring or going to that 0% lender?
Yeah, there are different loans, lines of credit that you can access based off of credit and income that aren't tied to any accounts receivable invoices. You want to do is get that type of financing first. It's generally more affordable than factoring. And then if you still need to do factoring because things are tight, then you've got that option to do that. And again, it is a relationship based business. Relationships around the world. The sooner you have relationships with different lenders who can issue credit to you and even have a factoring company ready in case you need it, the better you'll be. Trust and the speed of trust is a business owner's best friend.
Then also like having someone who's going to invest in your company. I know it's money in, cash back is also a say. So whether you become a stakeholder in the company or a shareholder in the company, assuming it's not even public yet, is that also another direction to travel in?
It definitely is because sometimes you have a product or service that could really grow and scale, but right now there's not enough income and profits for you to qualify for the type of financing you need. The only way to make those ends meet is to get venture capital, private equity, or a private investor who can deposit a lump sum of cash into the business so that you can make that investment. For example, with our fintech app, we're at that spot now where we're generating income. We've gone to market and we know that accountants and bookkeepers want a few additional features, which is going to cost us a couple more developers, which could be as much as an additional $30,000 a month, plus some other costs associated with it. So right now we're trying to look at, is it worth looking at venture capital? Do we just keep investing our own money to make those ends meet and get that built out? Sometimes it's worth it, especially if you're in a high growth potential company where your company could be very valuable in the future if you're able to get to market faster, that it makes sense. Now, the challenge in today's market is it's much more difficult than it was 2 or 3 years ago. 2 or 3 years ago, to raise that money was very simple because interest rates were lower and there were a lot of overvalued tech companies that were able to raise money. And now, fast forward 2 years later, a lot of those companies have had their valuations downgraded significantly because there was a lot of over exuberance on acting like your company was worth X amount when it was worth maybe half that or even less. It's a lot more difficult to raise capital now. But again, your network is your net worth. the more you can network with high net worth individuals and companies and build those relationships now, it will always pay off into the future.
One thing that interests me is business models that worry about the economy always seem sad that, well, a recession's coming, a depression's coming, a boom's coming, a this is coming. How do you help weatherproof your business so that you don't care what happens in the morning paper?
One of the best ways to do that is to create recurring revenue in your business. If the only way you earn money is by doing a job or service or selling a product here and there that's a one or two time interaction and transaction, and it's one and done, that's a problem. If you have subscription based models built into your business, then that gives you, number one, a lot of cash flow. It gives you predictability. And regardless of what's happening with the stock market, with interest rates, it gives you a really strong foundation that you can build upon and not have to be held hostage in the cycles of markets that are going to happen. So I'd say the sooner you can build recurring revenue models, and you can even do that in service-based businesses. For example, there are car wash businesses out there that sell subscriptions, and they are worth 3 times more than those that don't have subscription models, and they also have much more predictable cash flow. The sooner you can introduce recurring revenue models into your business, the less you're going to be swayed by what's going on in the news.
Let's assume you got turned down by a bank. How do you use what the bank told you to educate you to either change what you're doing, do it differently, or not doing it, that the turn down from the bank is actually the best news you could get?
Yeah, it's almost like when you get an upset client, right? You get an upset customer or client and they're complaining and throwing a fit. And what a lot of us as business owners will do is they're crazy. They're a really difficult pain in the butt client. They don't know what they're talking about. But if you dig into the details, sometimes you can really learn about a weakness or a leak that you have in your business that you need to fix. And the same thing happens if a lender turns you down. Your average daily balance in your business bank account is only $500, you need to get that up to $5 to $10,000 and stop taking out more than you put into the business bank account every month. That can be a big aha moment where you realize, wow, I've got to manage my cash better as a business owner. I might need to sacrifice a few months, and now I'm going to be in a better position, which ultimately comes down to saving money, right? If you can spend less than you take in personally and save money, it's the same concept as a business owner. There's certainly a lot that you can learn from a decline letter. And sometimes the other thing you can learn is that lender is overly conservative. They just had a bunch of losses and they are not lending. So move on to the next lender who actually is lending. It doesn't necessarily mean you're doing something wrong.
Is there a way to discern if someone says, here's a financial arrangement, some funding for you? Is there a sniff test that goes, yeah, there's something wrong with this, or this is super good? Other than yourself, who would know, you you live and walk this space all the time. How would a person discern that?
You just want to make sure that it really is the best option. Anytime you're working with someone who only has one or two options, lets you know that they're very limited and there might be better options out there. And what you'll see happen in this type of situation, I remember there was a pharmacist we were helping, and she had taken out one of these really expensive merchant cash advance loans for like $150,000, but it was paid back every 9 months or 12 months. It was so expensive that she had to keep taking out another one every 12 months. And so she could never get off of this treadmill. And ultimately, we're able to help her get a longer term loan with a lower interest rate and a 5-year payback. And so I'd say the one thing you want to be careful of as a business owner is making sure that you have affordable monthly payments. You can always pay something off faster and minimize any interest that you're going to pay on it. But usually in today's world, the biggest issue is anytime you take a short term loan that has to be paid back in less than 12 months, that's a sign that you're dealing with a high risk, high interest loan. And you better be really confident in your business model that you can pay it back. And you better have exhausted all the other options that are out there because there's probably a better option out there for you. The payback term. If it has to be a really fast payback term, can put you in a bind very quickly.
So I guess the proper thing to do is have your accountant be part of your solution. Someone does your books going, what are you doing?
You want to have trusted advisors around you as a business owner because you can't be an expert on everything. You should have your accountant, you should have a finance expert. Sometimes you should have even somebody who helps with tax structure that might not actually be the same as your accountant. Your accountant's good at telling you what happened. Not all accountants are good at telling you what you actually should have done before even starting the year.
Have you worked with anyone who has borrowed money or worked with a supplier or a client that they use their supply chain to do their financing because the relationships were already developed?
That's a great question, and the answer is yes. It's, sometimes instead of trying to go financing and go elsewhere, you've got this relationship of trust that you've built with your suppliers and manufacturers, and instead of getting that high interest loan or the high interest factoring, you can work a deal out where they give you a little bit more time to pay them back, and if you've built that relationship of trust and done what you promised before, they'll be willing to work with you. Maybe things aren't looking great in the bank account and you're not going to be able to qualify for a loan right now, but now you actually are using creative financing to do it through having a net 60, a net 90, meaning you have 2 or 3 months to pay for your manufacturing or supplies, whereas previously you were paying them quicker. If you just communicate with people, the worst thing you can do is if you get in a bind and you can't make a loan payment or you're struggling and you don't communicate with people and ghost them, nothing is more damaging to your credibility and reputation. If you just speak with them, there's going to be a solution there.
You mentioned that you have an app that you're working with. How does that integrate? Is that something that if someone's going to approach you, help them find funding and then manage the funding, does it integrate back to their office technology they're using, whether it's for accounting software?
It does. It does both of those things. It provides access to our funding marketplace, but just as important as everything else, it is an accounting software. It replaces QuickBooks. It does your profit and loss balance sheet and bookkeeping. It can make your bookkeeper's life easier. It provides a key financial indicator dashboard so you can see money in, money out, and cash balances. It lets you track cash flow and forecast it so you make good decisions within your business. And the reason we built it is we didn't find a better solution out there that did that.
Assuming that you can control the universe up to the level you can, what do you see in 2 to 3 years in your personal future that you're not doing right now?
That's exactly right, Wayne. In the next 2 to 3 years, we're going to implement artificial intelligence into the software that gives business owners insights into things they're struggling at that they don't see. It can look back over the year to date and let them know actually your payroll expenses have increased 25% this year, and yet your revenue and gross margins have gone down, which is leading to less cash flow in the bank account for you. Why is that happening? Why are you paying more for payroll now, even though your business has reduced its cash flow? And point out and ask someone the right questions. I had a mentor who would ask me, say to me, if you want to improve the quality of your life, improve the quality of your questions. And the more that we can invest in technology and utilize AI that asks us the right questions, I feel like that's going to help a lot of people.
When you're looking at somebody, what are the top three things you want them to understand about money and seeking funds?
Number one, make sure wherever you're putting the money, there's a high likelihood that it's going to generate a strong return on the loan or line of credit. That proof of concept and return is first and foremost. And then number two, make sure we're getting access to financing long before we're in a bind where we may not qualify for it. The time to get access to it is when we're in a good spot before we're in a bind that we actually are really desperate for the money. There's an old adage that the bank will be glad to lend you money as long as you don't need it. And so the time to get access to it is well before you're in a bind where you really need it. And then last but not least is that cash flow metric. Cash flow is why a lender will give you money, because they see there's extra money to be able to pay a loan back in a worst case scenario. The sooner you can manage that cash flow, the sooner you're going to be more fundable, more successful, and sleep better at night as well.
Leo, how big is your marketplace? Can you work with people in Ottawa? Can you work with people in Munich? How big is your geography?
Yeah. So when it comes to business financing, it is located only in the US, or at least with those with US credit established at Experian. That could be someone who built credit but now lives in Munich or somewhere else in the world, but they have US based established credit. Outside of the US, in Canada and the UK, if your business is generating at least $30,000 a month in deposits, we do have funding solutions there for those types of businesses. But if you're a new business under that, then there's just not a lot of options in those markets right now. And in terms of our fintech cash flow tracking and profit losses, those work the same no matter what country you live in the globe. And so our MyFigures software can help clients in any country who want to get their cash flow right.
Is that interfaced well with the banks?
It is.
Perfect.
Yeah, 99.99% of financial institutions are already established in that. So if you have a financial login at any major institution, then it's most likely connected up through our platform. So if you have to log in to 20 different financial institutions every month to manage budgets and business bank accounts and personal bank accounts and credit cards and investments and loans, whatever else you've got, you can literally put all of that in one place.
Leo, if you want to buy the book, or you want to buy the app, or you just want to get some wisdom, how do they get a hold of you?
Great question. I'm very active on LinkedIn and do a lot of posting, respond to all the messages I get every single day. So if you look me up, Leo Kanell on LinkedIn, it's a great place that we can connect. And then in terms of finding one spot where we can serve you, you could go just to sevenfigures.com, the digit 7, and then figures.com. We've got all of our free content, funding pre-approval, and cash flow software demos. Everything's right there on that website.
I want to say, you, Leo, thank you. We appreciate you being here today. And to my co-host, Wayne Pratt, co-hosting, and the Knack for Business listeners. If you're in the US, Canada, or the UK, there might be opportunities to reach out to Leo and secure funding at 0% or thereabouts. Plus, he has an app that probably outstrips QuickBooks, because I suspect that there's effort in this game for him. Reach out to us at info@creativeinsight.com. It's info at creativeinsight.com. And the website is at creativeinsight.com. Wayne, how can folks reach you, sir?
That's right. Here's my website, MOTIVE, the numeral 8, the letter U.ca, motivateyou.ca. And my email is wayne@motivateyou.ca.
If you would like to be a guest on this podcast and share your knowledge, let us know. We would also appreciate your feedback on the content or format. Check the show notes for more details. For these podcasts, we like to acknowledge the support and thanks to the following people: Carl Richards from Podcast Solutions Made Simple, a renowned podcast expert; Fred Crouch, who is the Property Wizard podcaster, where Bernie is a co-host; Jovan Strika from At Hive, a co-working space that is more than just a space; then Melanie Weber, Bernie's invaluable business partner; and Wayne Pratt from Motive 8U Inc., who serves as both a coach and co-host of these podcasts. Disclaimer: please note that the Knack for Business podcast episodes are meant solely for educational and general informational purposes. The information and opinions contained within are not intended to be professional advice on any subject matter. The thoughts, views, and opinions expressed by the participants are their own personal beliefs and do not represent the views of the podcast hosts or any affiliated organizations. It is important to note that this podcast is not a replacement for consulting with certified experts in your area who possess knowledge of your unique situation. The hosts of the podcast, along with any participants or affiliated groups, Do not take responsibility for any actions taken or not taken based on the information presented in this episode. It is highly recommended that individuals seek guidance from their own personal advisors in fields such as accounting, law, or other pertinent areas prior to undertaking any actions or making decisions that may impact their financial, legal, or other aspects of life.